Thanks for joining us for this company update report on Shoprite. So to touch on a bit on the summary of Shoprite, with the June year end, the company is obviously about 5-6 months into the end of its 2024 year. The numbers we still have are for the end of December, their half year. So just to touch on their last set of numbers, they obviously, we've all seen the inflationary pressures coming across multiple business sectors, but the retailers seem to feel that particularly. They did have a revenue growth of 14%, which was up about 6.5% like for like. But that mainly came through price increases as their volumes were down 1%, which is pretty much in line with all the retailers, the food retailers, that is. From a valuation point of view, it is quite pricey. It's above its long-term average. And when I did this report last week, that was before the rally we've seen in the SA markets on Friday and the beginning of this week. But the PE is quite high, looking a little bit stretched. But it is a quality company. You just are looking at quite a high price. The other interesting things to touch on their last results was their market share growth, which made it 56 months of uninterrupted growth, which is quite impressive. That's just under 5 years of market share growth. And the diesel costs were at 500 million for 6 months. Now that on an annual run rate of about 1 billion is quite a lot below what the worst case scenario was. That the worst case scenario was going to be about 1.8 billion for a full year. And as load shedding has come down a bit, these will all add to their bottom line and improve their margins, or just keep their margins similar to what they were pre-load shedding. We do have a hold recommendation with a slight downside, although now with the share price rally, it'll be a little bit larger. So going forward, with SA Inc. rising, some low inflation will always add to their margins, but we do think it's a little bit pricey at these levels.